Well, good morning and welcome to today's webinar. I'm Beth Hawley with the Arizona Realtors, and we're proud to bring you these free webinars designed exclusively to keep you updated on issues in the industry. Today's presentation will be about 35 to 45 minutes long. If you have any questions during the webinar, please write them in the question box and we will try to get them answered at the conclusion of the presentation. As always, today's webinar is being recorded and it will be available next week on our website at aaronline.com. Joining us today is Brian Dobbins. Brian is the owner of Dobbins Financial and has been involved in the financial services industry with a primary focus on income tax and retirement planning since 2000. Brian holds both life and health licenses and is also a consultant and advisor to many of the country's largest firms. Since 2001, Brian has been a member of the prestigious $1 Million Roundtable. Today, Brian is here to walk us through the tax law changes that are impacting your business. Welcome, Brian.
Thank you. I was telling Beth I typically do this to a live audience, but we put slides together for you so that you'll be able to kind of follow along with what it is that I'm talking about. Of course, when I was invited to come in and talk about this, you start to think about the largest tax law change in the history of taxes. And then I asked, well, how much time will we have to talk? Oh, we do it over a lunch hour. So it seemed to be a bit comical that we will talk about the largest tax law change in history during a lunch hour, but it won't take a lunch hour because we'll really be able to somewhat dumb it down and simplify it in a nutshell. I can tell you that as the workup was coming out with this tax law changes, we were getting bits and pieces of it on the IRS side and through Senate, Congress, and I can tell you that our clients at the firm were probably the most on the edge of their seat, as I've seen in my last 18, 19 years of doing this, literally waiting and getting bits and pieces from the internet. We heard things like, this is only going to benefit the rich. This is only going to benefit the poor. How do you foresee this happening? And what I told all of our clients was, we have to wait until this thing is done and signed before we can even decipher it and see how it's applicable. But as we go through these slides, you will be able to answer that question for yourself with some of the bracketing and some of the phase out thresholds and things like that we'll see in this presentation. You guys will be able to ultimately determine, because I think the words rich and poor coming from a client are probably somebody's opinion. Somebody that uses the word rich is in a completely different bracket than somebody else that's rich in a bracket. But we'll go through those brackets. There are some things in the code that were signed and finalized. IRS term for finalized is it won't be final until usually the mid to the end of October. So you guys may have some questions that I possibly can't give you the exact on today because the number's not finalized or what have you, but we'll go through everything that's out as of today. One of the slides that we'll come across in here today talks a little bit about home equity interest and the fact that the deductibility of it has gone away. There's no grandfathering in, there's no if this is old, this is new, but there's been some caveats to that have changed a bit. So we'll talk about that when we get to that slide. So let's just start off here and go to the first slide. That is the old tax brackets. Basically, these were tax brackets that were already in place before this new tax act impact was signed into. You can run across. I won't go through all of these specifically because we would be here for a day just talking about this. But these are, I always tell people, tax brackets are not your total income, but the tax brackets are after deductions. So things like medical, mortgage interest, property taxes, all of that. This is based on taxable income, and you can see the 10, the 15, the 25, and so on down the bracket. So these are old. These were for 2017. starting January 1 of 2018. If we roll to that next slide, you'll see where these brackets have changed too. And I guess one of my opinions about this, what we were talking about in the beginning, as far as does this benefit the rich, the poor, wherever you are across this board, you can see that all the brackets except for the 10% bracket have dropped down between 2, 3, and 4% is the ultimate change on that far left-hand column. And so I would just throw out the word benefit right off the bat and say that if the bracketing has dropped down a bit, then I think this is advantageous for everyone. So it sort of, I guess, takes the gamut of the rich and the poor in there. You can also see that, for instance, the 22% bracket, if you look at, for example, married filing joint, and you look at the top income in there, it spreads from 77.4 to 165,000. On that previous slide, the bracket that was the 25% bracket, so 3% higher, the income, taxable income, went to a total of 156,000. So they raised up the threshold as far as income that fits in there, and they dropped the bracket. So when we're running analysis for our clients, we typically see that most of the people that we're dealing with that are residents of Arizona, Nevada, places where the state income taxes are low, this has really come out to be a positive impact, like I said, whether rich or poor. We'll get into a little bit about why I specifically used Arizona and Nevada, because our unfortunate clients that live in California, our high state income tax rates, are not so thrilled about some of this for reasons that we'll get into as we go through the slides. So we'll roll to the next slide and talk about something that was always hot and heavy with people, and they refer to it as the marriage penalty. And basically it was, if you think about husband and a wife premarital, the wife made $75,000, the husband made $75,000. At $75,000, they were in a completely different bracket alone. But when they got married and we added that $150,000 number between the two wage earners, they did in fact have what was referred to as a marriage penalty. So not only an income tax accountant, but there were times I felt like I became a marriage counselor and was telling people, from a number standpoint, I don't think that marriage is wonderful, but I'm not going to stop the marriage for tax purposes. So now I don't have to have that conversation with people. So you can see in that there's a mostly does not impact a ton of people, but it's married couples earning taxable income over $400,000. There's still a bit of marriage penalty, and you can refer back to the first two slides that see what those tax brackets are to kind of understand the reason why we put that mostly in there. It does still impact a few people that are over that 400,000 taxable. So we'll roll over to the next slide. This was probably one of the big deals that we heard as far as the standard deduction is doubling, and this is so great. It was really kind of presented to everyone or sold to us as a tax cut. I use the word simplification, meaning they always have had a standard deduction for married or for single or for head of household, married filing separate. And then on top of that, we had personal exemptions for each and every person that was either on the tax return as a dependent or on there as a filer. They have gotten rid of the personal exemptions, and they have in fact doubled the standard deductions, but it's not way better, but it's better. So you can see on here, there's an example I put of a standard deduction, married or single person $6,500, and then they received a standard deduction of $4,150 on top of that. For 2018, they just get the $12,000 doubled standard deduction basically, and they do not receive the personal exemption. So it was $10,650, it went to $12,000. Is it way better? No. But is it better? Yeah. So that was the reason for this slide, is to be able to look at that. So mathematically, I always stop and think about the the married couple that has 3, 4, 5 kids, great that their standard deduction doubled from 12,000 to 24,000. However, all of the personal exemptions that dropped off of there may or may not kind of overcome the getting rid of personal exemption piece of it. So next slide gives an example of what those standard deductions went to. When we talk about standard deduction, it really encompasses, if I run through it as a tax form is laid out, this would be us adding everything together: medical, state income taxes paid, your property taxes paid, your mortgage interest, for some clients, their PMI that's paid, and then we move into charitable donations like cash and check, and then non-cash things. And then we used to have on that same schedule unreimbursed employee type expenses. So these could be things like union dues or uniforms or tools for a mechanic, things like that. They've got this new standard deduction number here that really encompasses all of that. So we do deal with some clients that maybe they were on the cusp of being able to itemize or not. And so with this standard deduction doubling, there will be some people that do not itemize anymore. We'll get into some of the things that are gone in the tax code that may or may not impact you guys as basically sole proprietors or your contractors. There's probably not too many of you today that are logged in that are employees. If there are, I would love to share some insight at the end on kind of our proactive approach to this tax law change for employees versus the contractors. And then for the contractors out there, as we get to the end of this slide presentation, there has been a huge change for what we call pass-through entities, or even if you're still filing as a sole proprietor on a Schedule C inside of your tax return, there's some great benefits that are in place now because the main focus on this whole tax cut deal was not on the individual side, but on the corporate side. And the philosophy behind that was our president now was really trying to figure out what to do to bring jobs back to the United States. And one of the biggest complaints that our business owners had and that people had in general was they could offshore manufacturing or production or whatever it be, and the tax rates outside of the country, the highest rate we were seeing was like 30%, and our corporate rate here was 35%. So they've now cut that 35% on the corporate side down to a flat 20, which I believe is going to help tremendously. But then we had little guys like you and I that were saying, well, wait a minute, if the big people get this big tax cut, then what about the people that are in business for theirself or that own small businesses? We all sort of raised our hand and said, what about us? So they actually came out with a wonderful deduction for the sole proprietor or the small business owner that we'll touch on a little bit at the end. And I had told Beth that it's probably the detailed portion of that is something that's probably saved for another webinar down the road, because that is going to take a little bit to get through. But it's something that at our firm we're passionate about taking the person that is the Schedule C, the sole proprietor, to becoming their own entity and becoming what's called a pass-through entity where they're employed by that. And we could talk a little bit about the tax savings from that. But the good news is, for now, whether you are a sole proprietor or you've created that separate entity, there's a big tax cut coming down the road that'll be effective January 1 of 2018. So everyone should see a pretty significant cut in taxes on that. So all the standard deductions are listed there. You can easily scroll over and see that they've basically doubled from where they were set to be. The next slide talks a bit about capital gains taxes. There's really nothing in the tax law that had changed with that. There was talk about taking away short-term capital gains and long-term capital gains. And the reason why I think this is important for you guys as realtors is we do have those clients that have rental properties that need to be sold or that will be sold, and we have clients that have more than the excludable gain on a primary resident that we were worried about capital gains rates changing from where they were to becoming taxed at a higher rate. The good news is those stayed exactly where they were. There's really been no change with it, and I don't foresee that they're going to disrupt this anytime soon because it basically keeps people in the market. It keeps people invested for the long term, in my opinion. And if they were to get rid of these favorable tax law changes that they've had for quite some time, I think it would really disrupt the market, which ultimately messes with the rest of the economy. I put a slide right after this one that talks a little bit more in depth about those capital gains rates. I think they're interesting to scroll across, and you look at long-term capital gains rates. This is any property and or asset that's held for a day longer than a year. I think it's pretty interesting to see that you can be taxed at a 0% capital gains rate if you're married filing joint on up to a combined income of $77,200. That's a big number. Most of our clients, most of the people that we'll work with will stay inside of that 15% bracket. That allows us to go up to $479,000 as a married filing joint couple, and then the highest that we can get to is 20%. And back prior to these tax law changes, they didn't have a 0. They had a 10, they had an 18, they had a 22, and they had a 28. So I think they've done a significant job of cutting that down to somewhat keep people holding on to property or assets longer, whether it be stocks, bonds, things like that. And I think that's ultimately led to the market performing pretty well. And once they signed this act and kept those rates in place, I think that's a part of what we've seen happen with the market. I think people were a little skeptical on whether they needed to sell or not to get the old long-term capital gains rates, but then they came back out and they've kept everything intact. So I don't foresee them changing that even when this is all set to expire in 2025. Roll on to the next slide here, just kind of an in general, but it goes along with the statement of, did this help the rich or the poor? Child tax credits have always been out there for our clients or parents that have had children under the age of 17 in the house. Used to have this phase out for married filing joint at $110,000, which had not changed in decades, and we were a little bit upset about it. $110,000 married filing joint combined income this is not even taxable income. This is just combined adjusted gross income. We had felt was very low as things had changed, as we live in an economy where $110,000 for a married filing joint couple and we're talking about people with at least one child in the home, was not enough to be where it needed to be. So to have to tell our clients that they lost that child tax credit because their income was too high was a little bit disheartening. So you can see they jumped that up from $110,000 to $400,000. That was a significant change. We were actually asking for them to just please double it. So when we saw it go from 110 to 400, or from 75 as single to 200, we were ecstatic, I guess you could say. And that goes back to, did this help the rich or the poor? And you guys all have to determine if the 400,000 is rich or poor. But I think it definitely encompassed and helped a lot of people. The 17 and older, we'll roll to the next slide. It has a different kind of topic, because this would go back to our clients that have 3 or 4 kids in the household. You've got, that 17 or 18-year-old that's a senior in high school, and you've got that kid that's 19 that we just haven't been able to shove out of the house quite yet. but they're still members of the household, and we're sitting here thinking that we lost their personal exemption deduction, but there is a $500 credit that affects people in the household that are 17 and older. A $500 credit is different than a $4,000 personal exemption for some people, but the $4,000 exemption basically forced you to not have to pay taxes on $4,000. So based on wherever you were in a bracket, that could have been, a $300 savings or a $700 savings based on taxable income. So they just came out with a flat $500 credit that somewhat takes care of the personal exemption that we don't maybe qualify for with child tax credit because of age on a child. So that was nice to see them throw that in there. I thought it was a nice caveat. They talk about child independent care credit right below that. It didn't go away. The numbers have stayed the same. So any of us that have children, daycare type stuff, that is still intact. We'll roll over to the next slide that has the education tax breaks. In the beginning, they were talking about eliminating the deductibility for tuition and basically like after high school degree type stuff or even non-degree. They were going to get rid of all the education credits. All of those are still completely intact. They still have the lifetime learning credit, and they still have the American Opportunity Credit, which is for your first 4 years. The thresholds for income are not out yet. I don't think there's any way they're going to go down. I think they're going to go up, but they're not released and in final yet, but they did keep all of the education credits intact. On another note, there's 529 college savings plans that the parents and the grandparents and everybody have loved. One of the big things with that was, what if the child didn't go to college and they didn't need it, or what if there were multiple children and it needed to be passed along? So one of the big things that they've done with these 529 plans is they've actually, in this new tax law change, they've made it effective so that you have the ability to use those funds for tutoring from literally preschool up through high school. Obviously, you can still use them for college. And then it also allows us to pay for private schooling now from K through 12. So that's a huge deal. We have a ton of clients that pay for private schooling or for after school or in school type tutoring that's separate than just enrolling in a public school or private school. And before, there was never any type of tax break for it. But now, if we can get people to utilize these 529 plans, which allow the deposits go in post-tax, Arizona does give a credit, a tax break, I should call it, $2,000 for one, and up to a grand total of $4,000. So you can reduce your Arizona taxable income by up to $4,000 by using this 529 plan. So it's on the federal. We tell people it's basically a post-tax type credit, not anything big on the federal. But however, what happens with these is they do grow 100% tax deferred, and the money comes out 100% tax free as long as we're using it for the tutoring or the private school funding, or if we're using it for basically anything for college. So we can buy laptops and we can pay for so much stuff in the post-secondary education world with it. So that was kind of a cool break to see that may or may not impact you, but if it does, we should utilize that. We will roll on to a slide that's probably of most interest to all of you guys today, because we certainly had this tossed around a bit as far as, are we going to be able to deduct mortgage interest? We heard it was going away. We heard it was staying. We none of us knew. So when this all came out, I don't understand the reason from the 1 million to the 750. I would now jump over to the side of the desk if my client said this hurts the rich people. I would be on that side, and especially when we're dealing with our clients that live in California or on the East Coast, places where property values are much higher than here. And now we're having to tell those people that if they do go out and acquire a new loan and have mortgage interest of over $750,000, that it is no longer deductible. So it changes the game plan of people as far as how much of a home they're going to buy, what they're going to finance, how big of a down payment. That was, always has been one of the benefits, right, of home ownership is deductible mortgage interest and tax savings and things like that. It went into our planning with the client of, do we withdraw money out of some account to put a larger down payment, or do we keep that invested because the interest rates are so low to borrow money? Now when we're dealing with people where this is starting to get up over the 750, it changes those parameters a ton. And then the other big part of this is the home equity loans. This was not something that was even grandfathered in. You can look at loans taken out after December 15th of 2017 are affected by this 1 million down to 750 cap. If you were in one of those mortgages prior to December 16th, you're good to go, no change. However, if you take out a new loan, if you refinance, if you get a new property, whatever it be, and we're over that 750, we're going to lose that deduction. So there was a grandfathering on the primary notes that were being taken out, but the clients that have or were planning on getting home equity lines of credit, they completely, starting in January of 2018, lost the ability to deduct that home equity interest in full. I don't agree with that in particular. You've got people that had a home equity line of credit prior to, and now they've just lost that deductibility. One of the caveats that has changed that is not on this slide, because we as practitioners all threw a really big fit. If we have clients that are taking out home equity lines of credit now, or if they had taken them out prior to, and they use that home equity for improvements to the home, something affiliated with the home, that interest remains 100% deductible now, up to a loan of $100,000. So this is even for your clients if they've still got the ability to do 80-10, 80-15, or 80-20 type loans. That 80-20 might be a dirty word to use now, but I'm not sure if they're still doing that a lot in Arizona. But your clients have the ability to deduct that interest as long as it's tied to the home, which is how it used to be years and years ago. Then they changed the law and said, we don't care what you use your home equity line of credit for. So people were, buying dogs and paying off credit cards and things, and it was deductible. So they did want to put a stop to that. But when they originally wrote this act, it removed all of it, which we were, again, all balking about the fact that this is not fair for people that have had to do a home improvement or a repair or an expansion or things like that, or even, had gone into an 80-10 or 80-15 loan to avoid PMI. We did not feel that was fair. So again, we balked and cried, and they brought that back. The detailed part of this that we as practitioners always laugh about is we don't know how the provability part of that is going to work. We ask a client, what was the home equity line of credit used for? If it's used for the home, I guess the IRS has the ability to come back and ask, can we see documentation on that? But sometimes they do this stuff, and I don't think they quite understand the mess that they're creating for themselves. So we've never had a client that's been questioned on it. However, it does need to be for improvement, linked to that property that the line of credit's taken out. So we're just happy that it's back, and that people, at least if they had those loans and they were used for that, can still continue to deduct that. Charitable contributions, just that next little paragraph down, there's really nothing in there that we need to talk about. A little bit on athletic tickets that are purchased and things are no longer deductible. I don't think that's a big deal to most people. The medical expense deduction threshold, you used to have to have more than 10% of your adjusted gross income on the federal return to be able to use those deductions. They've lowered that down to 7.5%. So I do think that will be a benefit for some people that unfortunately have those big medical deductions. I think it's fair to note that on the state of Arizona, we still continue to take all medical deductions as an itemized deduction. There is no threshold to get over. So when we're dealing with clients that make 100,000 before they needed more than 10,000 to be able to deduct medical expenses. So sometimes you would have a client that didn't care about it but not realize that it was deductible on Arizona. So if any of you out there have missed that, you should fix your returns and add those in for sure. We'll roll over to the next slide, which to me has the most significant impact to the tax code that's in here. I think that this is going to impact more people than anything else that we have talked about. So I know one of the important pieces of this was obviously is mortgage interest deductible. We've talked about that. Yes, they've lowered it. We know that. But this SALT deduction is going to impact some people, and we'll just run through some scenarios here. We used to be able to deduct all of our state income taxes paid. We used to be able to deduct all the property taxes paid. We could combine that number together and we could deduct it in full. There was no threshold. There was no issue with it. Another part of that piece for our clients in Arizona, some other states as well, vehicle license fees were added into that. So now we take all of this that we've talked about. So these are property taxes, and this is your state and local income taxes combined. Once we get to $10,000, you guys are cut off. There is no more that we can deduct. There are, I guess, quite a few people in Arizona, because I tend to think that we have pretty low property tax rates here. So that $10,000 may or may not be a big deal. But I'll give you an example. We file a lot of returns for people that live in the state of Texas, and a very modest home in Austin, Texas at $250,000, $300,000 will have a property tax bill of $20,000 to $22,000, $24,000 is not uncommon. So people will move there, clap because there is no state income taxes, but then when they see what the property taxes are, they're a little taken back. Big deal, but then not a big deal because we were able to deduct that. Now those people are capped at $10,000. It's going to impact those people significantly. Another big part of our client base is based in Southern California. And you think about people that live in California that make $100,000, the state income tax rate in California, the pretty basic rate is 10%. So you have somebody over there that makes $100,000. They've paid the state of California $10,000 in income taxes for the year, fully deductible. But if they own a home, not $1 of their property taxes are going to be deductible because they've hit that $10,000 threshold. So if we just jump that up to a bit to average people in the Orange County area making $200,000, $250,000 and owning a property that's probably $1.5 million to $2 million, they've got $20,000 in property taxes, $20,000, $25,000 in state income taxes, and now the only thing that they can deduct is that $10,000. So we were absolutely shocked when we saw this number come out because we do have quite a few clients that live on the East Coast, and I think about the Delaware states, and people that live over there have huge property tax bills, and to think that these are going to be capped now at $10,000 was a kind of a blow to this whole tax act reform signing. We still can't believe it went through. I don't know if something will come about where they'll possibly appeal it or try to jump it up a little bit, but it is going to impact a lot of people. I think that it will be interesting to sit back, if any of you work in the California market where the housing is pretty high, to see if you have people that are either moving because they now have this $750,000 threshold to live with, or the people that have lived over there for a long time and have their state taxes kind of grandfathered in. If those people move into something that's 750 and they've got large property tax bill that's going to adjust with the new assessments and that, I think it's going to be interesting to sit back and look at California and the higher property value, higher income tax states to see what happens with the housing market over there. I just don't see a lot of people wanting to poke the bear and get taxes reassessed or take on a new loan knowing that it's not deductible when they're already being hurt with the $10,000 cap. So you guys can let me know if you have California people what you're seeing over there. But I have a prediction that the higher end stuff will possibly slow up a bit because people certainly like that deduction that is now, unfortunately, on the mortgage side capped at $750 and the state and local tax cap at $10,000. So to keep me informed on that, but we already are starting to see a lot of our California residents that are moving here. I always joke and say you probably can't go sit in a restaurant or bar in the town of Prescott and not be sitting next to someone that is a public safety officer that is retired from California and moved into the Prescott area because of what their pensions are bringing as far as being able to buy a house here. They're sick of the high state income taxes and things like that. So we are, which is good for all of us that do business in Arizona and that live here and rely on that we have a tremendous amount of growth and people that are moving in here. So I think all you realtors are out there that you're in a good spot. You'll be selling to and selling for and all that stuff for a long time to come because I don't know how long it'll be before we have California residents because they're all moving over here. So we will see. Next slide talks a little bit about deductions that are disappearing. There used to be a very small column at the very bottom of a Schedule A on your itemized deduction sheet that is now gone inside of this and included things like unreimbursed employee expenses. These would be uniforms or tools or union dues, anything that you needed to buy as an employee that your work did not provide was usually not a big deal because people could deduct it. It is completely gone. Tax preparation fees are a part of that column. You no longer will be able to deduct that if you are an employee and if you only file an individual tax return. On the corporate side, it is still absolutely deductible. And that will be another reason why we talk about any of you that are still filing a Schedule C as a sole proprietor. We really need to talk about that at the next webinar in a little bit more depth because I think you'll see more people that'll kind of switch over to that for a few reasons. The rest of the stuff, moving expenses, employee parking, things like that, those are all gone. And if any of you out there are in fact employees of realtors or working at brokerage firms that you're an employee and not a 1099 contractor through your real estate broker, we need to have a separate discussion about some ways that pay can be structured in order to allow you to still continue to buy the things that you need to be able to complete the task that you do for your employer and still have those benefit you in a tax favorable way. So there is ways that can be structured through the employer, and I don't know how many of you we'll find out maybe at the end if any of you have any questions on that, but I can give you some of our strategies to in fact continue to make that stuff favorable from a tax side. We'll roll over to the next slide. This has to do with healthcare that did in fact impact us all, probably more so people that were individual contractors like most of you that had to carry your own health insurance. Did we carry it or did we not? Did we pay the penalty or did we not? Nothing is changed for 2018. We still all needed to provide some form of health care for ourselves and dependents on the tax return. In 2019, effective January 1, all of those penalties are gone. So the Obamacare, as we knew it, is gone, and you no longer, by IRS statute, have to carry health insurance or pay the penalty. So I think that there are people that are probably clapping that that's gone. It turned out to be a little bit more of a mess than I think people thought it would. I understood the philosophy that they wanted people to have it, but they didn't have a way to enforce the penalties, or they had people that were claiming all kinds of crazy things on tax returns to get out of the penalty. So I don't think it did what they wanted it to do. So roll to the next slide here. This has to do with what we had talked about in the beginning. So pass-through deductions, and does it apply to you? Pass-through entities do include, you can see on here, income earned as a sole proprietor, an LLC, a partnership, or an S corporation. So for everyone out there that is not an employee in the real estate world that's receiving a 1099, this has an impact on you, a significant impact. One of the questions that we're still having, if you just look at the very bottom of this, there are phase-out income limits that apply to professional services. They have not specifically listed a real estate salesperson as a professional service in a list of a few. There are things like attorneys, doctors, accountants, some things like that that they have fit in. They are revamping this list. So we'll, I guess, stay tuned to some of the finals that come through in October on this to see if they really provide us a legitimate professional services list. Again, it only has to do with the phase out. So if we're working with a realtor that is, single and 157,000 or less, or married 350, it doesn't matter if you guys show up on the professional services list. You'll still have the ability to deduct this 20% of pass-through income on the tax return. So I think it's pretty significant. If you're a real estate agent and your tax accountant did a wonderful job of getting your net income down to as low as they can, but they get it to 100,000. With this new tax law, we have the ability to not even tax 20,000. It's a 20% of no tax on that income. Basically, this was put into place because we as little guys all stood up and waved our hands, and we're not on that big corporate level. We weren't big C corps that went from the 35 to the 20. So they came up with this 20% as kind of an offset to that, as a kind of in general. It's a huge deduction for everyone, in my opinion. Every client that we work with that meets this pass-through deduction criteria was significant to see the ability to remove 20% of that income and let them know what the new tax liability was going to look at for 2018. So big deal. I will be more than happy to get an email list of everybody, or I'll send it to Beth as soon as that professional services list comes out, because it keeps kind of going back and forth and we just don't quite have it all pinpointed down. So again, it's only, as you reach that phase out. So if you're over that phase out, then we're definitely going to be sitting waiting to see if you guys show up on the professional services list. If you don't, then we won't care. So we'll roll over to one of the last slides here. It talks about the estate tax issue that's been in place. They've done a good job with this. It used to be at more than $1 million worth of assets. There was, in fact, an estate tax that was applied upon someone's passing. $1 million was not enough. We all cried. It was pretty easy to get clients there. If you had somebody that owned a $600,000, $700,000, $800,000 home and then had some retirement accounts and things, was a big deal. That got raised to $5.6 million a couple years ago. In the new tax law exemption, they in fact doubled that. So single people have to have a total estate more than $11.2 million before any of the estate taxes apply. Single or married people went to $22.4 million. So I think that will help a tremendous amount of people out that live in our state, and they will no longer have to worry about estate tax planning. So that wraps up all of the slides that I have for you guys today. Again, there's I'm sure a lot of questions. There's a lot of detail as far as the specifics of clients that you guys work with and specifics of your guys' individual situation. We are more than happy as a firm to take those questions and do consults and things and help you guys through that. But again, I think if we look at this whole big tax law change in a nutshell, I think it's beneficial for the majority of the people out there. And I think that with some good planning and proactiveness that we can all walk away with some kind of benefit from this. So I thank everybody for listening to me ramble on. Like I said, if there's any specifics or anything that we can do for you as a firm, please feel free to call or email me, and we'll set some time to go through specifics. So, all right, that is all I have for you.
Great. So what is your email and phone number?
Yeah, so email address for me is Brian, BRIAN, at dobbinsfinancial.com. And the main office number is 602-279-5464. And we will be more than happy to help you guys out. We have a lot of real estate sales clients and deal with some of the brokerage companies here in the Valley, and would be more than happy to help anybody out. So hope everyone has a great day, and I hope you guys continue to do well as everyone moves over here from California and needs a home. So,
well, we do have a couple of questions. Do you have a minute? Okay, great. So just to clarify, everybody wants to make sure that there's a clear understanding that sorry, I lost the question. the personal exemption for kids, that's still...
It's gone.
It's gone. It's gone.
There is a $500, so there's a child tax credit for kids that are 16 and under. And if you're married filing joint, your adjusted gross income is under $400,000. If you have a child that is 17 or older, or a parent situation or a member of the household, instead of that personal exemption, which is gone effective January 1 of 2018, there's a $500 credit that will go on the tax return instead of reducing the income by that personal exemption amount. So that is totally gone for everyone listed on the tax return now.
And the mortgage interest is still good as long as it's under seven.
The loan amount is $750,000 or less, not the property value, but the loan amount is $750,000 or lower. If someone had a loan that was larger than the $750,000, as long as that was taken out or started prior to December 16th of last year, 2017, then there is absolutely no change.
And the line of credit interest deduction is gone.
Is gone unless it was used for the home itself. So improvement, repair, there's all kinds of verbiage that goes in there. But basically, we couldn't have a home equity line of credit we took out years ago that we used to buy a ring or a cat or a dog or pay off credit cards. It had to be something. We could remodel a home, we could replace an air conditioning unit, put a roof on, add a room, all of that stuff counts, but the stuff that is not tied to the home does not.
So what about a pool?
A pool is an improvement to a home. Yeah, absolutely.
And the mortgage insurance?
Is still intact, okay. But we have not heard what the phase out amounts will be. At $108,000, I believe was that number prior, married filing joint couple that had PMI could not deduct it when the income reached that. There was a phase out there. They have kept it, but we don't know what those phase outs are going to be yet. They have not given us the final numbers on those.
Okay, great. Well, I think that's all the questions we have right now. They can reach out to you if they have anything additional.
Yeah.
And this presentation has been recorded and will be available on our website in about a week. Meanwhile, if you'd like to email me or Brian, we'll get you the slide deck if you're interested.
Perfect.
All right, great. Well, thank you all for attending, and we hope to see you at our next event. Check aaronline.com for the schedule. Have a great day.